Hey guys, it's Eddie Deline here. In this video, we're going to be talking today about market rent versus current rent. What I'm talking about right now is quite often I'll personally buy a property, clients will buy a property, I'll be speaking to someone about an investment property that they're trying to buy right now or they're thinking of buying. And very often, let's say we've got a property for $350,000 and the market rental amount, so the rental appraisal, as an example, from a property manager, and you can physically see on Real Estate and Domain that all other ones, maybe they're all advertised for $500 plus a week now, as an example. But then when you try to buy that particular property, it's $350,000. The rent at the current time is only $380 a week. So what should you go off? Should you go off the current rent? Should you go off the market rent? That's what I'm going to be elaborating, explaining a little bit more about, my thoughts, opinions, and, experience with this subject. It's because it's a very common scenario. Often, same scenario might have an amazing, phenomenal property to a client that's in Brisbane or Perth, wherever the market is at the moment, and it's $350,000. It's currently rented out for $380 a week. And I'm putting all these, we do all the data analysis, we due diligence in regards to the growth, the vacancy rates, et cetera, et cetera. And we provide different examples of other ones that are on the market. So if we can see, if we've got rental appraisals from multiple property managers, and then all the property managers have said between, let's say, 500 to 550, then to me, that's what the rental, that's what the yield you should actually go off. I feel like this is very confusing kind of situation, because some people will go the other opposite direction. They'll always go off what it's currently rented out for. But what it's currently rented out for, let's say there's 5 months left on the lease, as an example, and it's rented for $380, and they can't put it to $500, $520 plus or more, whatever it may be, whatever the market rent should be, for another 5 months. So automatically some people think, oh, well, the property is going to be extremely negative, and this is going to be a negative yield property, it's going to be negative cash flow, and it doesn't make sense to buy it. But there's many other factors that you've got to consider at the same time with this. Like, if the property is, let's say, $50,000 under what other ones are on the market for, well, then you've got to look at the equity position and the cash you're essentially making on the way into the property as well. I bought one property as an example, right? It was $500,000. I knew I could rent this thing out for about $650 a week, but it was currently rented to like a relative of the original owner. It was like a cousin's friend or whatever it is, right? And it was rented for literally like $350 a week. So there was a $300, it was like, should have been rented for $650, but it was only rented for $350 a week, as an example. So it was like a $300 difference. So almost double the price. Now, when I was buying the property, I bought it a good like $70,000 under what it was worth, because it was a distressed sale. It was phenomenal buy. But it had a lease in place for literally like 7 months. So 7 months of time, I had to rent that property out because I couldn't change the lease at that particular time, unfortunately. The tenants had already decided to move out prior anyway. Like, they knew at the end of the lease they were moving. I'm pretty sure they're moving into state anyway. So it's not like the rent was going to get bumped up a significant amount and issues were going to happen or anything like that. They were already planning to move out, but they did want to continue that lease because they knew they were getting a bargain for the next 6-7 months. So for the first 6-7 months, I actually had to buy a property that was, significantly $300 a week negative cash flow. But what I did in my mind is like, the property is about $70,000 minimum under what it's worth. Now, what is $300 per week over a year? Like that, off the top of my head, doing rough calculations, like $15,000 a year, right? $15,600 roughly. Now, for the next 6 months, I'm on that lease. So 15,000 divided by 2 would be, $7.5 grand roughly, right? So yes, I'm negative $7,500 in cash flow over the next 6 months. But the property I'm buying is $70,000 under what it's worth. So I'm not going to throw away 70 grand personally, because the property initially over the next 6 months is going to be 7.5 grand negative cash flow. Because after that, I even rented that property out for more. I rented out for 700 wins, not 650. I rented out even more. So there's things like that. To me, it's common sense, but I didn't have this, didn't have this experience or common sense when I was first starting out. But it's something you need to consider, because some properties that you buy, they might be phenomenal value, but they could be on an old lease. And there's different things that can happen. Like, let's say there's an amazing buy out there, but the current owner or current property manager hasn't increased the rent in 7 years, right? So in that same scenario, it's rented for 380, but it should be 500. You shouldn't go off the current rent because the current rent is from 7 years ago. It doesn't make sense. You need to be going off what the actual market rent of the property is, because you're not going to have this property for just 6 months. In an ideal world, in terms of building an investment portfolio and creating wealth and building a property empire, you want to hold properties for as long as you can. A loan term, when you sign the loan documents that you're going to sign when you're buying a property, they're generally for 30 years. So try to think of it from minimum 30-year perspective. Don't think of it from 6 months perspective, because that rent, as an example, will go from 380 in 6 months. You get new tenants, or the rent will go up to 500 to 550 a week, and then 6 months out of a 30-year period, what is that percentage of time frame? It's tiny. So sometimes it's a short-term sacrifice or short-term pain for the long-term 30-year gain. And throughout history, rents are inflationary. They go up in value throughout history. Properties in metro areas have always gone in an upwards trajectory on average of 5 to 6% per year as well. So this video is market rent versus current rent. Have to do this because I've spoken to thousands of people over the years, and sometimes they've thrown away unbelievable opportunities, which if they didn't want them, maybe I would have then bought them myself, and many of them that's happened, because they were originally under rented, maybe $50 a week, less than what they should have been. But you got to 90% of the properties that we pick up, again, are 90% already tenanted, and that forms part of the reason why many sellers, when they're need to sell very urgently, could be an urgent sale, distress sale, bank repo, but if they have a time constraint and it's tenanted for 6 months, that's part of the reason why we're able to snag this property at such a really good price, because the owner's in a time sensitive situation, good or bad, they need to get rid of the property, and there's a tenant in there. So having a tenant in there, basically doesn't allow for owner occupiers, those buyers that are going to pay top dollar for that property. So property that would normally sell for 400, 420, you pick it up for 355, 360, and you're getting that margin on the way into it of 50,000, and you get the ability to then potentially go back and get it revalued, use the equity to buy another one. So market rent versus current rent. To summarize, do not always just take the current rent as what you're going to be receiving for the next 30 years, because it's not logical to think like that. You got to think long term. Look at the market rent. In the emails, like if I've presented your properties, if my team presented your properties, look at what's actually on Real Estate and Domain right now for rent. Do a rental analysis, and that's what basically property investors, and not everyone knows how to do this, but it's basically looking at current rentals that are on the market, and even getting a rental appraisal from 1 or 2 property managers. You're having that long-term perspective when you are considering an investment property purchase. So thanks for watching. Any questions, give us a call, shoot us an email, and thanks for watching, and I'll chat to you next video. Bye for now.